IIFL Finance's Q1 FY 2027 numbers show net profit reaching 675 crore rupees, a 160% jump, while revenue expanded 32.7%. Although gross non-performing assets ticked up slightly to 1.55%, the sheer volume of revenue growth keeps the overall recovery trajectory heavily skewed to the upside. The primary engine driving this cash generation is the resumption of their gold loan disbursements. Backed entirely by physical collateral, these loans carry an interest yield between 18 and 24%. By securing approval from the Reserve Bank of India to restart this segment, IIFL has successfully processed its recent regulatory hurdles and rebooted its most reliable profit center. The addressable market for these credit products extends deep into semi-urban and rural India. In Tier 3 and Tier 4 cities, formal credit penetration remains below 20%. This pie chart breaks down IIFL's current asset mix. Gold loans make up 30% of the book, followed by home loans at 28%, microfinance at 22%, and SME loans at 12%. Because of this structure, 90% of their total lending book is secured by hard assets. To originate these loans, the company operates a physical network of over 4,500 branches, which they integrate directly with a proprietary digital lending stack to minimize processing times and overhead costs. Over the next 5 years, management expects to scale this footprint to 5,500 branches by the end of fiscal 2027. A major target for this expansion is affordable housing finance, where they project a 25% compound annual growth rate in home loans, subsidized by the government's PMAY 2.0 scheme. The resulting profile is a highly diversified credit distributor, positioned to capture the ongoing financialization of India's rural economy. Translating those operations to the equity market, IIFL currently holds a market capitalization of roughly 24,000 crore rupees. Over the last 3 years, the company maintained a revenue growth rate near 20% annually. Looking at this valuation matrix, we can plot IIFL's trailing price-to-earnings ratio of 15.8 against a massive 381% year-over-year jump in earnings per share. This discrepancy creates a highly attractive PEG ratio for investors. Zooming in on leverage, the company's debt-to-equity ratio sits at 5.03. For a non-banking financial company, this keeps managed gearing at roughly 5.7 times, safely within regulatory limits. Their return on equity is trending toward an impressive 19.5%, while return on assets has rebounded to a highly efficient 3.1%. Despite a recent period of regulatory overhang, the company's internal capital efficiency and cash generation capabilities remain intact, trading at a significant discount. Evaluating working capital for a lender requires a different lens than a traditional manufacturing firm. Instead of physical inventory, we measure receivable days and the speed at which assets under management rotate through the balance sheet. IIFL operates with high velocity in these working capital metrics. The rapid turnover is driven by the wide net interest margins generated directly by their gold and home loan segments. Because 90% of these assets are backed by secure collateral, the capital recovery process in an event of default is heavily insulated against total loss. Furthermore, the loan book relies on highly granular, small-ticket loans provided to retail customers and MSME borrowers. This extensive fragmentation means customer concentration risk is practically non-existent. The headline earnings reported by the company are backed by actual, highly efficient cash flows from a strictly secured order book. This forensic indicator dashboard tracks the company's internal corporate governance metrics. Promoter holding remains stable, and the data shows 0 pledged shares. We also see auditor fees moving in perfect lockstep with total revenue and profit growth. This alignment clears a major red flag that frequently appears in the financial sector. The primary existential threats to this operation remain external. The Reserve Bank of India maintains strict oversight over the NBFC sector, and IIFL has already experienced the severe operational impact of regulatory interventions. Within their current portfolio, the specific pressure points are the Samasta microfinance division and the unsecured MSME loans. Both segments are highly sensitive to macroeconomic stress and borrower leverage limits. While the internal governance metrics pass forensic checks, successfully managing microfinance stress and maintaining strict compliance with the RBI remain the company's largest operational hurdles. This split screen chart compares IIFL directly against its industry peers. While IIFL trades at roughly 16 times earnings and a price-to-book of 3.06, competitors like Bajaj Finance trade near 39 times earnings, and Shriram Finance sits near 24. This massive discount relative to the sector average provides a clear margin of safety for value investors. This candlestick chart highlights IIFL's strong bounce off its 52-week low of 400 rupees. The price action completed a bullish flag pattern, breaking out above 479. The 20-day, 50-day, and 150-day moving averages have formed a positive trend alignment, sloping upward and providing support. These technical indicators are no longer lagging behind the data. They are actively confirming the fundamental undervaluation thesis directly on the price charts. This valuation thermometer plots the three main analyst consensus targets for the stock: a bear case of 580 rupees, a base case of 750, and a bull case reaching 900. With the stock currently trading in the mid-400s, the bear case target offers a mathematical safety net. The downside is heavily protected, skewing the risk-reward ratio strongly toward the upside. Projecting 5 years out, if management sustains its guided 25% asset growth and maintains a return on assets above 3%, achieving a 15% compound annual growth rate on the stock is a highly probable outcome. For long-term investors willing to tolerate occasional regulatory headline volatility, this stock is a strong hold or buy, with an ideal accumulation zone between 429 and 450 rupees. As always, perform your own due diligence before investing. However, the data points to IIFL as a textbook example of a fundamentally sound financial institution emerging from a temporary crisis-induced discount.
India's energy infrastructure is rapidly scaling to support electric vehicle adoption and massive new battery energy storage systems. By 2032, the country's total electricity demand is projected to hit 2,500 billion units. Despite this massive consumption, only 8.4% revenue flows from the day-ahead market, the real-time market, renewable energy certificates, and new markets for gas and carbon. In a business where liquidity dictates dominance, IEX controls an 85% market share, giving it a near monopoly on short-term power trading in India. This dominance stems from its technological architecture. IEX uses a continuous matching algorithm that pairs buyers and sellers instantly. Its main competitor, PXIL, relies on a slower batch auction model. Traders gravitate to IEX because high liquidity ensures better price execution. The platform relies on a diversified base of state distribution companies and industrial users. This network moved over 141 billion units of electricity in fiscal 2026. Based on this built-in network effect, management has projected electricity volume growth of 15 to 20%. The Ministry of Coal has granted in-principle approval for IEX to establish a coal exchange, opening a completely new multi-buyer, multi-seller market. IEX provides the foundational infrastructure layer for India's transitioning energy ecosystem. IEX currently commands a market cap between 10,800 and 12,400 crore. Its revenues have climbed consistently, scaling from 449 crore to an estimated 618 crore for fiscal 2026. Growth is accelerating. In Q1 of fiscal 2027, IEX posted consolidated revenues of 157.88 crore and a net profit of 134.76 crore, demonstrating sustained momentum across both year-over-year and quarter-over-quarter metrics. With zero physical inventory, operating expenses are remarkably low. Walking the income statement backwards from net profit reveals a structural EBITDA margin around 80%. That margin is supported by multiple trading streams, capturing fees across the day-ahead market, real-time trading, and renewable energy certificates. Despite these margins, the stock currently trades at an EV to EBITDA multiple of roughly 21.1x, which is lower than its historical average. The core profit engine functions smoothly, without the physical friction or inventory bloat that characterizes traditional energy utilities. The balance sheet carries virtually zero debt, with a debt-to-equity ratio of 0.0034. Without debt or heavy physical assets weighing down the denominator, efficiency metrics remain high. IEX generates a return on equity of 39.4%. Inventory days are zero, and the free cash flow to revenue ratio is a massive 82.31%.
The ratio of cash flow from operations to profit after tax indicates that reported earnings are translating directly into liquid cash. By every standard metric of capital allocation, IEX functions as a high-margin cash machine. A forensic review shows no red flags. There is no abnormal spike in auditor fees or sudden rotation of auditors, and management returns 60 to 65% of profits to investors through dividends. Because IEX operates as a technology exchange, traditional banking metrics like gross non-performing assets are irrelevant to its evaluation. The shareholding pattern reveals an aggressive accumulation phase. Promoter holding is zero, removing share pledge risk. Meanwhile, foreign institutional investors have climbed from 12.63% to 18.53%, while retail holdings have steadily declined. Combined with a stable domestic institutional holding of over 34%, this transfer of equity highlights a pattern of institutional accumulation. This creates a sharp contrast. Despite these return ratios and institutional buying, the price-to-book ratio has collapsed to just 10.7x. That 10.7x multiple represents a 36% discount to its own 5-year average of 16.8x. This institutional accumulation is accelerating at the exact same time the valuation multiple has hit a 5-year low. The markdown is driven by regulatory uncertainty. The Central Electricity Regulatory Commission has proposed a market coupling order, which would mandate a uniform clearing price across all power exchanges. If implemented, market coupling could neutralize IEX's proprietary price discovery advantage. Analysts estimate market share could erode from 75% towards 60%, though implementation challenges have delayed this until at least December 2027. Against this risk, IEX has strong ESG tailwinds. Surging volumes in the green real-time market and renewable energy certificates make the platform necessary for entities meeting environmental compliance mandates. This tension is visible on the technical chart. Down 27% from its 52-week high, the stock is trapped in a consolidation phase around 122. The price remains compressed below key moving averages. A decisive volume breakout above the 150-day moving average confirms a reversal. Underlying metrics remain constructive. The weekly average delivery volume sits at 40.54%, indicating that buyers at these levels are taking delivery to hold rather than just trading the volatility. Regulatory fears have forced a technical markdown, but the high delivery volumes suggest the stock is building a base of long-term holders. We can map out 3 valuation scenarios. In the bear case, if market coupling triggers severe volume destruction, the stock could test. Base case assumes the company maintains a 10 to 15% growth rate while sustaining its 60% dividend payout. This yields a target zone of 140 to 160 rupees. In the bull case, the new coal and gas exchanges scale rapidly enough to offset any market share loss to coupling. If that succeeds, the upside target sits at 215 rupees. Over a 5-year horizon, if IEX maintains its 15 to 20% volume growth, a re-rating could drive a 15% compound annual growth rate, pushing the stock toward the 240 to 260 range. For investors willing to tolerate short-term regulatory volatility, the current 10.7x price-to-book multiple offers an entry point into a zero-debt, highly profitable wealth compounder.